Welcome everyone, Professor here. In this video we'll be looking at life cycle costing. This is our third installment in our practice topic. It is a topic that's very misunderstood, as many people just truly don't understand what life cycle costing really is, or they apply it incorrectly, usually leaving out cost values that should be included in the analysis. Life cycle cost is too expensive. I've heard that so many times before in my career, I can't even count it. Let me tell you, this is a myth. Life cycle costing actually costs less in the long term. It's often said by those who do not understand what constitutes real life cycle costing. In fact, life cycle costing increases the value of any facility asset. So what is life cycle costing? It starts with the acquisition of a building or facility. It goes through its operation, through its maintenance period, and renewal period. Those are both topics we've already covered in our deferred maintenance video, ultimately to the disposal or end of life. Now that end of life could be the actual tearing down of the facility and the revitalization of that land, or it could just be that particular entity selling that facility off and moving to a new one. But that's basically what the life cycle cost is all about. Life cycle cost analysis accounts for all costs of the facility's asset through the life cycle. Understanding this principle causes us to think different ways in making our decisions. For instance, the replacement of a system fewer times reduces the cost burden over the life of the facility. In other words, if I have that facility for a certain length of time and I replace a particular system 3 times instead of twice, it actually runs more, which actually devalues that particular facility. This comes from a result of 2 basic principles. Principle 1, the least expensive anything will be is today. Costs will always go up over time. There's no exception to that. Raw materials go up, labor goes up, transportation costs go up, inflation, they all have an impact. So we need to understand when it comes to buildings, construction, maintenance, that those big expense items, the cheapest they will ever be as far as budget goes is today. Principle 2, Business 101 or Economics 101 as I call it. There are 3 important factors to create value. They are fast, good, and cheap. Sometimes you'll hear them mention as schedule, scope, and budget. It's the same thing. But the reality is in business and economics, you can only have 2 of these, not all 3. Principle 1, impacts of inflation on costs. And if we look at escalation, and for the bulk of my career, we've been using for the last 30 years or more, a 2% escalation per year. Now, if you look at this, in year 0, which is the year you do it, we'll take $0 because it doesn't matter what those dollars are. It's just that. In 20 years from now, if that system fails and I have to replace it, at 2% per year, it'll be a 40% increase by inflation alone. Then I add another cost of 100, which is that. So in 20 years, it goes to 140. 20 more years, again, I have another 40% on that, plus the extra 100. So as you can see, that 20-year system will basically cost you 380% from today over that 40 years. If you do a 40-year system at only that 2%, you get to 180. Now, and 7-year escalation, which is what we had at the beginning, say almost a year ago, we were starting to see that escalation as we were coming out of the COVID to 7%. Now you can see how the numbers change, where it goes from 0 to 240 to 280, and again, 280 being what you get on a 40-year. What we're actually experiencing, at least right now, and it seems that for the next 2, 3, possibly 4 more quarters, we could be seeing escalation of 7% per quarter. Now, that's where the numbers get absolutely astronomical. As we can see here, at 20 years is 660%, 1,320% for year 40. this is just ludicrous. So that's the importance, and that's why we start having to change our mind thoughts about the longer life systems versus shorter as we look at building renewal and even in preventive maintenance. Now, keep in mind, this example only accounts for inflation. There's no accounting for the raw material increases, labor, or distribution, as we see right now, where fuel costs are very, very high. What is shown is the potential huge savings from a system with a longer life over a system with a shorter life. This is based, by the way, only on inflation. I can't say that enough. But when we start in life cycle costing, adding all these other factors in, we start to see that this has got a significant impact. This consideration alone indicates a change of decision-making process. From our preventive maintenance to our building renewals, we're going to start looking at taking on systems that are a little bit longer in life, because it will gain value by shortening the amount of overall cost through that useful life of that facility or that building. Let's look at principle 2. Here are those 3 things we talked about: fast, good, cheap, or schedule, scope, and budget, any way you look at it. Now, you get any 2. What we're talking about is you can focus on that on that time quality leg. That means it's not going to be cheap. Okay. If you turn around and you concentrate on that cost quality leg, of course, you're not going to get it fast. And then when you turn around and you focus on the time cost, well, of course, the quality is going to be sacrificed. This is just basic economics that we have to understand. Now, you can start to see how these choices you make under the principle 2 can change both our short-term and long-term outcomes, because as we focus on a quality or a scope of work, we end up starting to see that it changes the outcomes of the other 2. You can see how they're all related. It's like a 3-legged stool, and focusing on 2, the other one's always going to be the one that's going to vary. Now, let's bring that to an example, and I'm going to bring it to a very, very basic example. Let's take a gallon of milk you buy for, say, $1.80. Now, that milk, you'll consume in 10 days, okay? So your refrigerator cost for running for that 10 days is 18 cents per day to run. So if you have 100 items in that refrigerator, the milk is ultimately going to prorate to about 3 cents over that 10 days, which means the total cost of that milk is $1.83 for the life cycle that you have, without counting inflation, replacement costs, or anything else. So you start to see, even on this small scale, it does have an impact. So this is directly applicable to building systems. When we increase the life of life cycle of a building system, it increases the useful life of that building directly by delaying the need for building renewal. In fact, by choosing a longer system, you may actually reduce a cycle out during that life. For instance, if the building has a life expectancy of 50 years, and you put a 40-year roof on it, you literally only have to, from the day you put it in to the time you replace it basically about 10 years before the building's useful life goes out. If you put a 20-year system on it, now you're going to put on the roof you begin with plus 2 other roofs before you hit that 50-year mark. You want to see some more information on this, please look at the video on deferred maintenance that's on this channel as well. What is part of the life cycle cost analysis for an entire building? That's the big question. What do we include? Operational costs. Now, this is water, gas, electrical consumption, and other utilities. It could be other things that we have as well. We have to look at maintenance costs, not just preventive maintenance, but the building renewal. If you're doing it for the life cycle costing of the building, you know that many of those systems are going to be replaced during that time. HVAC, fire alarms, any of that stuff will be replaced. Others not quite as often. Inflation is going to have to be part of that. You're going to have to gauge what that inflation is, deal with that inflation, and add to it as part of this analysis. And of course, taxes. The government gets its hand on everything. And then, of course, there's always escalation in raw materials, in delivery of that stuff. Even when we look at operation, just the facility that requires paper towels and toilet paper, every year those costs are going to escalate. You've got to count that in when you're doing a proper life cycle costing analysis for a full facility. So what else is included in that? System replacement costs. You know that you're going to replace your HVAC system about every 15 years. So if we look at about a 50-year life, we're going to be replacing that HVAC system at least twice from the initial. You want to make sure that that gets included in. Depreciation, again, like new cars, as soon as you drive them out onto the lot, they're going to not have as much value. Now, real estate and buildings tend not to depreciate as much. They certainly appreciate, which means you can build equity. Now, here's the other thing. As you start to extend the life of that building, you go beyond that 50 years and you start to move towards that 70 years, you're actually building equity, because most of the time we analyze these buildings, we usually think that they're about a 50-year life expectancy. So that extra 20 years is a huge plus. You need to also account for additional income. If you have rental space in it, if you have parking, anything that would be generating additional costs need to be part of that analysis as well. These are just some of the things to mention. You know, it's hard to get a whole, in a short video like this, develop a whole thing. This is just to give you some ideas so you can do some appropriate research for as time is needed. Is there such a thing as too much quality? The answer is yes. It ultimately wastes resources because failure may come premature. I'll give you a perfect example. I bought my very first truck. It was a Chevy S10. Bought it off the showroom floor, and within a couple years, needed to get new tires. Here in the Arizona weather, the UV lights beats the heck out of the rubber tires. So what I ended up doing is I saved up, because it was a little bit more, and I got those tires with the really hard rubber and an 88,000-mile warranty. And I thought, great, this is going to be wonderful. I paid about 25–30% more for those tires, but thought it was a good investment. But the problem is the tires ended up dry rotting out before I got to the point where I wore down enough tire tread to move it. So essentially, kind of wasted some resources there by buying these really, really high-grade quality tires, but I didn't get enough mileage on them to actually buy what I was buying for. So I could have gotten probably those 40,000-mile tires and probably made a better value out of it through the savings and through the fact that ultimately around here, dry rot's going to kill the rubbers and tires and windshield wipers long before you get that. Life cycle cost can reveal this type of quality goals that can show ineffective or wasteful resources by us choosing to go beyond what probably is a quality level we don't need, and so we need to be very, very aware of that. If you want to read more about life cycle cost analysis, click on the link below here in the description for an article that I wrote as well. Be sure to watch the video on deferred maintenance. If you have not seen it yet, please see it. It does have other information that relates to the topic that we've just been talking about in life cycle costing. If you find this video helpful, please be sure to like this video, subscribe to this channel, click on that little bell to receive notifications every time a new video is uploaded. Remember, design well, build safe, and be sure to maintain our buildings to give longer life to them. See you next time with the professor.